commodities are now showing a sign of an upturn. Overall competitive intensity continued to remain high. In this backdrop, we have delivered another quarter of profitable volume-led growth. Domestic consumer business grew by 4%, which on an underlying basis, after adjusting for the impact of phase out of excise duty benefits, as well as one-off credits in the base year, was 5%. Underlying volume growth was 4% and it was broad-based. Let me talk about the performance of the various segments. In the soaps and detergents segment, there was robust volume growth, which was offset by continued price degrowth. In soaps, Dove, Lifebuoy and Hama delivered robust volume growth. And in laundry, let me just take a break. Here's some noise here, guys.
I think that's a commercial break on the other side.
Continue,
Good to go? Okay,
please.
In laundry, Surf continued to drive category premiumization, while Vim Liquids led the performance of household care. Moving on to personal products, we delivered a healthy intrinsic performance. Reported growth in this segment was impacted by the phase out of excise duty benefit that I alluded to earlier, as well as the residual impact of the realignment of channel spends, which we had called out in the previous quarter. Skincare delivered broad-based volume growth across Fair & Lovely, Pond's, Vaseline and Lakme, while hair care sustained its volume-led growth on the back of Dove and Tresemme. Oral care, Close-Up continued to do well, and we relaunched Pepsodent Core during this quarter. Color cosmetics, Lakme delivered another quarter of strong innovation-led growth. Moving on to our foods and beverages portfolio, beverages maintained its consistent performance across tea and coffee, and in packaged foods, we delivered another quarter of double-digit growth. Our growth drivers, which is something we have talked about many times over, continue to be the relentless focus on innovation, focused market development, impactful activation, and sharper in-market execution. And this has resulted in good growth in emerging categories like fabric conditioners, hair conditioners, green tea, and the like. The investments in brands were sustained at competitive levels, and the overall A&P was up 65 crores, that is plus 40 bips in this quarter. Let me now talk about our financial performance. As I said earlier, the turnover growth was 4%, and PBIT margins, that is profit before interest and taxation, improved by 115 bips, resulting in a PBIT growth of 11%. Cost of goods sold was lower by 240 bips due to lower commodity costs, as well as a strong savings program that continues to fire. Profit after tax, but before exceptional items, that is PAT BEI, was up 13% at 1,031 crores. Net profit was up 7% at 1,090 crores, the growth rate being impacted by the exceptional income of sale of properties in the base quarter. In summary, we have delivered another quarter of profitable volume-led growth consistent with our strategic intent. Let me now pull back and talk about the full year performance. Domestic consumer business grew by 4% with 6% broad-based underlying volume growth. The intrinsic growth was 5% after adjusting for the phase out of excise benefits and one-off credits. Profit before interest and tax for the full year grew by 10%, with the PBIT margin improving by 90 bips, despite the net impact of the net excise duty hit of about 50 bips in the year. The margin improvement was delivered even as we continue to make significant investments in A&P, where A&P was up almost 160 bips this year. EPS at 18.87, the growth rate was impacted fundamentally by the exceptional income due to property sales in the prior period. The strong track record of cash generation continued for yet another year, with HUL generating almost 5,000 crores plus for another year in a row. And hence, against a backdrop of challenging market and deflationary cost environment, we have delivered another year of competitive, profitable growth in this year. The resilience of our performance is fundamentally a reflection of how we have dynamically managed the business and the rigor we have in executing our strategy that we have put out. We continue to strengthen the core of our business, lead market development of emerging categories, and invest behind our brands and organizational capabilities to win with our consumers and customers. The Board of Directors has proposed a final dividend of rupees 9.5 per share, 9 rupees 50 paisa per share, subject to the approval of shareholders at the upcoming AGM. And this, together with the interim dividend of 6.5 rupees per share, the total dividend for the year ending 31st March 2016 amounts to rupees 16 per share. Looking ahead, we expect the market growth improvement to be largely dependent on rural. We see a pickup in commodity prices in recent times, and in this context, we'll continue to focus on driving volume-led growth while continuing to improve our operating margins. And our strategy and our goals remain the same, that is consistent, competitive, profitable, and responsible growth. Now over to you for questions.
First up,
one second. Here, and then you come in.
Volume growth has come in at around 4%. What was expected was largely in 5 to 6%. A lot of talk about how the poor monsoon the previous year might have affected this volume growth. Talk to us about volume growth in the light of a poor monsoon last year, and going forward, we are expecting a better than average monsoon this year. How do you see that playing out in terms of volumes?
If you look at the markets, same time last year, the volumes have come down by nearly half. So in that context, we are growing ahead of the market as far as the volumes are concerned. And if you step back a bit and look at the last 3 years, our volume growth has moved from 4 to 5 to 6. So on a year basis, certainly we are very satisfied that it's been volume-led growth. That's what our strategy has been. This year, like I said, one is the markets have softened, especially rural. The other is what Balaji alluded to. We have realigned the channel spends. Yeah, and this was the work we commenced last quarter. This has now got over this year. And as Balaji again said, looking into the future, it depends on how the rural market picks up.
Right, in terms of rural areas, you've seen some sort of softness in rural areas. So run us through how you expect the rural markets to pan out, in view of the drought that has hit some areas, as well as the prediction of above average monsoon.
See, we wouldn't like to do crystal ball gazing as far as the rural is concerned, but the factors which have impacted rural. Yeah, there is severe drought in many parts of the country, which would have impacted the demand for our kind of products. And certainly what we are looking forward. In fact, the whole country is looking forward to good rains. Yeah, we need it. We need it for the people of the country. Yeah, and that will certainly be an impetus. Also, the government of India has recognized the stress in rural, and that is the reason, if you look at Honorable Finance Minister's last budget, he has allocated more spends for the rural areas.
So that just that you understand, we don't treat rural as for us, rural and urban markets are both important. That's the nature of our business. And therefore, our read and our understanding of the rural markets is actually very good, because we actually penetrate deeper than, I would say, most companies can. And therefore, we understand the ground reality. In fact, when we have been calling out the fact that rural demand has slowed down for a period of time now.
For nearly a year.
And the fact of the matter is that we can see what is going on. Now, that does not mean that we are sitting quiet and waiting for the rains to come, because that will of course help. But we are continuing to step up our investments and our direct contacts into rural markets so that we can do our bit to spur demand up, and we have programs like Shakti and so on and so forth. So I think we've got to keep in mind that we continue to not wait passively, but are also proactively stepping up our game as much as we can. But tailwinds will help.
But what kind of indication as far as pushing up that pent-up demand is concerned? What is the kind of push that it would give as far as volumes are concerned?
See, from our perspective, like we have always maintained, we don't look at just getting a share of the pie. We always focus on how do we grow the pie. Yeah, our investments in the last couple of years in market development has significantly accelerated. And this we have been doing it so that we can build the nascent categories. Yeah, take the experience to people across the country. A large amount of investment goes in rural area. So from our perspective, we are doing our bit to ensure that the market keeps growing, and we keep growing in a competitive fashion.
How do you make sure you tackle leave rural aside for a
I think we'll have to give other people last question from you, because there are several other hands going up. Right. Okay, carry on.
The thing is that one is rural. We've been discussing rural ever since the start. Just moving away from that.
Yeah.
Competitive pressure hasn't eased up either. I'll take names of here. A brand like Patanjali coming to the market is giving sleepless nights is what we hear to the FMCG big boys of the country. You're the biggest FMCG boy in the country. How much does competitive pressure from these new brands like Patanjali coming to the market, especially in the soaps and detergent segment, affect a company like HUL?
You know, I think you have been around long enough to understand that we don't really comment on competitors, but more importantly, the reason we don't comment is because we believe the focus should be on our consumers. And you are the best judge after our consumers in terms of our relative performance. Fact of the matter is, our ambition is always to grow ahead of the market, but as Sanjeev very importantly said, bulk of our growth comes in our ability to develop markets, which is to increase the size of the market. We continue to do that, and it is never one category or the other. And the other thing, if I may say so, we have been doing it for years, and we hope to do it for many, many years to come, because our focus is relentlessly on our consumers. So, if you have any questions on any competitors, you should attend our competitors' press conferences. I'm sure they'll give you some nice, interesting facts. Sorry, let me just get one question here and then we'll come to you.
Speaking about pricing, last couple of quarters since the input costs have been low, you have also taken a couple of price cuts. How do you see prices, pricing panning out for the coming fiscal, given now even crude prices are firming up? So how do you see that panning out?
As I said, alluded to last time itself, I think when commodity prices came off, we did move in proactively to ensure that we stayed competitive in our pricing aspect. Now we are very clearly calling out be it crude or vegetable oils. Both have started to move up, particularly vegetable oils, which has run up pretty significantly long way. And therefore, we will obviously look at, as we always say, all lines of the P&L to ensure that we stay competitive. At the same time, we recognize the fact that there is commodity price increase coming through. A business of our size would do well with a reasonable degree of inflation, because it gives you leverage across all lines of the P&L. And with the vegetable oil prices is almost 50% up compared to what it was in December quarter to where it is now as it's trading now. Therefore, we would be intervening on the price line as well, but that's not my first starting point, but we will definitely ensure that we stay competitive.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.